Good morning, everybody at Money Printer Pro. It's Monday, April 20th. I'm Garrett Baldwin. Thank you so much to the large number of people who signed up to be members this weekend. I appreciate it. Welcome, welcome, welcome. I am Garrett Baldwin. I am the writer, author, cameraman, voice. Um, that's about it. We'll go with that. If you haven't seen this before, this is the daily market update that we do pre-market. We do this after I do the Money Printer Morning Burst show and the write-up, and then we walk through a lot of the different tools that we have here available for you, plus a brief on everything that is in the email that is below. The most important thing, of course, is the capital wave number. And the capital wave number right now, you see that little yellow box. That's important. All right, so this is the score. This is the score that turned negative on January 28th before the larger, broader sell-off that happened. And then, of course, we turned positive back around April 7th at the end of the day for the S&P 500, positive for the Russell on that Monday, April 6th. And now we're waking up 2 weeks later to a very stretched financial markets. And one of the key things that I do want to point out, when we looked at this number on Friday, breakout number was 34 on technology, 0 breakdown stocks on technology. That is fundamentally important. That is a very stretched market where there just aren't sellers in this environment. But right now, we're starting to see a little bit of a pullback here. And the key thing here is we look at the screamers and crashers. These are the stocks statistically breaking out. Stocks to the right are the ones statistically breaking down. Keep an eye on Oxy, APA, and TPL to come off this list. In addition, everything that's happening right now in Iran, looking at the fertilizer trade, good grief, CF had been selling off and had looked weaker. But now as we start to pay attention to what is going on in the Gulf, the longer that this rolls on, this can resume its trend very quickly, as can these U.S. oil producers. We're paying very close attention to Oxy and looking for a move back toward that 20-day moving average. So this is the environment where you buy a call maybe around 54 and sell a call out of the money, looking for a very specific statistical setup. This is the type of environment for that if you are a trader. Right now, though, for oil and gas, I am still focusing where I always focus for long-term investors, for people who pay attention to postcards and the type of portfolio that we have over there. It's really about the pipelines. It's about companies like Energy Transfer, EPD, MPLX, even anything that's tied to Marathon as well. There's a lot of opportunity out there long-term for these names. But as we wake up this morning and start to see the narrative shift on the back of the OILU, well, here you go again. Remember, we talk about these leveraged ETFs and ETNs a lot. We don't try to trade them. We just simply watch them because they become very good tools for helping us understand where leverage lies. 2 Sundays ago, I told everybody, watch this line, or maybe it's 3 Sundays ago, watch this line like your life depends on it, talking about the OILU. It broke quickly under its 8-day moving average, and when it broke under its 20, that's where the real damage has really happened in the upstream oil and gas space. Everything was impacted. We also watched the SPXL and the SPXS. This is where momentum turned positive back around the 7th and the 8th. We were about a day ahead of this move, but this is where the big mega cap stocks have pulled this market higher. We've moved to overbought. That's important. And again, Goldman Sachs saying that this market is primed for a sell-off. Very simple technical rules are telling us that profit taking was already likely to happen this week. And now, where do we sit? But with the possibility of a revival of this war. On the capital wave numbers, the reason why this yellow has popped up and why we want to be a little cautious and why maybe you want to sell calls, spreads, or call options on existing positions is because our pulse number, our daily momentum figure, is negative. It has gone to -4 this morning. The larger, broader weekly figure, which really matters much more, that is positive. That's been positive going back over 2 weeks. But this is just telling us right now, profit taking, kind of that mantra of more sellers than buyers, just people taking some risk off the table at the moment. So we pay very close attention to this. The Russell is still green. Now that's interesting, but I will note that there are very few stocks on this side. Also, when you get into a world where you have very few names on this, that also could signal a top as well. So once again, high caution and be very, very diligent about what you are buying at this moment. Other thing, we've talked about the launch pad. We provided that has now part of the tools that are available. Remember the F score, Graham score, and 20-day moving averages. Stocks that have moved into this list: Village Farms International, Malibu Boats, Winnebago Industries. Might want to exercise a little bit of caution. You can see this stuff is fueling. One of the key things to note about this, though, and this is very important, that these are largely consumer-driven stocks. And if this fails, it's largely going to be tied to the bigger and broader narrative. But write the name down again. F scores in the 7 range, low Graham number on the Winnebago, and approaching that 20-day moving average. The runway tells you what its possible move is to the next major technical line. So that's the 50-day, the 100-day, or the 200-day moving average in most of these examples, which is why, when we're making these trades, we want to look for those stocks that have a relatively larger gap. Or if you're going to look for a 3 to 6% move on some of these names, you buy the call at the money and you sell wherever that line is, wherever that 50-day moving average is. That will define your risk up front. We'll go deeper into this during the week. Don't worry about it. But that'll define your risk up front, and then we can set a natural stop if we are targeting a move to those key technical names. Last thing that I just want to talk about this morning that we have added, because once again, the Treasury General account was so critical in the last couple of weeks, that $200 billion drawdown that coincided with this market getting off the mat. We have added some plumbing, and we're in beta at the moment. We're still working on this, but very important just to keep this in mind. You want to be watching what is going on with treasuries. You want to be watching what's going on with Fed Reserve numbers and Fed total assets. TGA hitting 971, 5 days adding $300 billion. That's coming out of the equity system into the Treasury General account. We're watching the SPY. So we're going to have these signals. They're going to be added soon. We're focusing on the Treasury plumbing. We're focusing on the Fed operations. We're focusing on volatility and conditions, where momentum lies on the S&P 500. And then, of course, flow and news. We're adding just a couple of different RSS feeds to this, paying attention to what Zero Hedge is talking about with this, largely because Zero Hedge does have relationships with the desks. So we'll see what Goldman is saying, what Nomura is saying. We're looking just to see if those articles are being written anywhere else, or if we find things on Twitter that are discussing these issues, we're going to stay ahead of it and ensure that we're always paying attention to what broker-dealers are doing, what CTAs are doing, and what's happening at the institutional level, specifically looking for clues around the possibility of forced buying and forced selling, which was a major driver of that action on the S&P 500 over the last 2 weeks. All right. Good stuff. I don't know. All right, here's your update for this morning, April 20th. Last week, the S&P 500 pushed all-time highs. The NASDAQ hit its longest winning streak since 1992, and the Russell hitting a record. Liquidity, CTA buying, and massive Treasury injections tied to tax payments and a ceasefire that may never have been true. CTAs bought about $86 billion in 5 sessions. Remember, that's why we have to watch this. We modeled to buy about $70 billion more. Everything was squeezed. People were happy again. The Treasury quietly executed one of the largest, actually the largest debt buyback in U.S. history. What they do is they go out and they buy mid-tier, mid-duration, long-duration bonds, and then shift that burden to the front end of the curve. That unleashes liquidity in the bond markets. They're focusing on buying illiquid bonds. Dealers were offering almost $40 billion of debt, and only 15 was purchased. Nobody held a press conference over this. The plumbing was being actively managed, and that's important. We always want to note this. This is about active management, an active regime, and active actions. Active. How many times can I say that this morning? The core thing here is just that this is being managed. It's not on autopilot. This is a coordinated effort to keep and maintain our debt situation in a very prioritized manner toward the front end of that yield curve, and to ensure that the plumbing is clean. This morning, Iran shut down the Strait again. The Navy's firing and seizing ships. We talked about all of that in the pre-market. But again, oil is up 6%. Futures are down across the board. The timing between extreme positioning and headline events has become very hard to ignore. There are investigations into whether people are trading ahead of these moves. I would not be shocked to see somebody else made a big bet on Friday afternoon, particularly coming on the backside of Third Friday, which is when options expiration for April happened. That said, I will take a little bit of credit. As I said, OIOU pushed toward oversold. So we were looking for short covering anyway heading into this week. And now with Iran and the situation unfolding as it is, that puts us in a situation where the squeeze can continue and move higher. So pay attention to names like APA, Occidental. These are actually names that you might even want to consider doing some, relatively short duration trades where you buy deeper in the money and sell just a little bit out of the money. So you have a higher probability of profit target, maybe in the 60% range, but you also have a targeted gain somewhere in the 50 to 60% range, and you just manage that trade. You don't aim for a blowout move on oil to 120. You're just trying to take advantage of the small structural momentum that can build in energy prices this week. The key headlines are the same. Hormuz is in full crisis. The 10-year has risen to 4.26%. Eli Lilly is near a $2 billion purchase of Colonia. I don't know what that is. Boston-based Colonia Therapeutics. Congratulations to everybody up there. Oil has surged, WTI at 88. Gold dropping 2% to near 4,800. The Hormuz escalation is reigniting those inflation fears, but once again, the core concerns remain the same, that we see for selling or selling in gold to buy energy. The bullion, gold is down 9% since the Iran war began, but I do remind you that we saw excess speculation in the gold markets before this happened. Back around January 30th, we saw gold had exploded up toward about 5,500, and then there was a leveraged sell-off. There was literally forced selling across the gold and silver markets, and that was seen in the leveraged ETFs. And finally, China is reviving coal to gas projects. So, climate change, everybody. A lot of focus there. 13 coal to gas projects are under construction or being planned. Okay. Cool. All right. The extension and the flinch. We saw a negative move on our pulse this morning, the equal weighted pulse going negative. So that's the first crack in last week's momentum. And for things to turn, it has to start somewhere. And it does start in the pulse reading itself. The monthly and the weekly thresholds are still green, but the pulse measures what's happening right now. And it did flip negative heading into this pre-market. The tech and the mega caps are still carrying. We have a lot of earnings this week. Intel will report. Tesla will report as well. We want to watch Broadcom, which is running as well. Energy has been under pressure. The breakdown names are clustering in the upstream E&P and refining, and those are the ones that can drop off this list and start to move higher. Pay attention to the FNGD, the FAZ, and the VIX, and watching the OIOU. If they all flip, we will be going back to our 6 rules for negative momentum. April 22 is the date. Yeah, because that's when ceasefire would be over. Buying to selling ratio is extremely low. Nobody's buying their stock, so let's not even worry about that. The TGA drawdown is being rebuilt. The Fed is still at $25 billion per month, but that is a larger flow that has passed. The rally now leans on what happens in the Middle East. So if oil drops and yields ease, spreads will tighten. When oil goes back to 100, that stuff reverses. We have to pay very close attention to the ceasefire expiration. We obviously know that Vice President Vance is heading back to Pakistan for conversations. Remember, the S&P 500 went from oversold to all-time highs in 10 days, and that is drawing in every last willing buyer. Now it needs to find real legs, or this was one of the most aggressive bull traps in the history of the world. Everything the Treasury did to ease the last 2 weeks will be tested with the answer on April 22nd. So remember, this is a trader's world right now. We are living in it. We would love to get back on offense, but until the data says it's safe, you want to be disciplined. This is the time to look to potentially take some profits. Or if you are in the market for the long term, look out 5, 10, 15% higher than where your existing equities are and consider selling calls on those existing positions. If they pull back, the premium that you generated by selling the call, giving someone the right but not the obligation to take that stock from you. If the value of the stock pulls back, the value of the call will fall. You can sell that back, or you can buy that back into in the market and just pocket the premium as well. All right, everybody, I'm going to wrap it up. I hope you have a great day. If you have any questions, or if you're new or you're looking for different tools, remember we have in our platform a kind of a getting started set up for you if you need it. So easy things that you can just do. Just keep in mind, you're going to want to go here to getting started. And as you'll see, what's capital wave, understanding momentum, what's liquidity, reading price charts, everything that you need to know to get started, selling calls, doing spreads, focusing on insider buying. We have content there for you. Any other questions, you know where to reach me. You can hit me in the chat or just put a comment in the section below. And I hope everybody has a great day. Stay positive.